Welcome everyone to this Park Launch session, Fireside chat with a long-standing investor in the region and a good friend. So I hope everyone's recovered from the Saudi trip. Obviously a huge amount of activity, and that's pretty kind of close to what we're going to be covering on this session, which is the emergence of the MENA region and the Gulf in particular. And we're fortunate enough to have Khaled Talhouni with us, who's going to be taking us through, I guess, his journey. And then in addition to that, a few key themes as they're evolving in the region. So, hi, Khaled.
Hi, Wes. Thank you. Thank you all for having me. Really appreciate the opportunity.
Fantastic. So I think let's start, Khaled, with a little bit of, if I may, a little bit of a personal journey in terms of, I guess you went to college in the US and you grew up in Jordan, I guess. So give us a little bit of that picture, because it's just good context as to, what shaped you, I guess.
Yeah, for sure. So I'm Jordanian originally. I think grew up mostly in Jordan, spent some time in the UK and then Canada. Then went to university in the US, Duke University. I majored in economics and history. And then the kind of traditional pre-professional track back then, and I think still is to some degree now, is to go from that sort of university and that type of degree to investment banking. That would have been the natural kind of route. I did a summer internship in New York, like most of my peers, and I absolutely hated it. So I decided that like this is really not for me. And so I thought maybe I go to law school or I go do something else. And I had an uncle living in Dubai, still lives in Dubai actually. And he said, well, while you're figuring it out and maybe study for the LSATs, why don't you come to Dubai, maybe get work for a year or two, and then you can go to law school or do something different. So I ended up here in Dubai in 2007, sleeping on my uncle's couch. And I was trying to kind of figure out what I can do for a job, at least to get some kind of work experience. And it was a very odd time, and I wasn't really sure what I wanted or what direction I wanted to go in, and I found it a bit tough, actually. So by sheer coincidence, I met Walid Hanna, who was the founder of, who is today the founder of, one of the co-founders of MEVP. But back then, he had just left Abraj, actually, to join another PE that doesn't exist anymore as well, called Dubai International Capital. And at Dubai International Capital, they wanted to help build the one of the region's first early stage funds, a seed fund, effectively, and also build an angel network around it with the idea to incentivize angels to invest. This was sort of a side project, somewhat, I don't want to say kind of CSR, because it was intended to make a return, but to really give back to the community. It's all very small, the $25 million fund. Basically, I joined there not really knowing much about really anything at that point. And it was just me and Walid Hanna, and we ended up raising most of that fund. We ended up deploying a few companies. Back then, there was really not that much deploying in the tech space, so it was really kind of SME startup focused. Amir Farha, who later co-founded Beko and then did Koto, also ended up joining us. So there was the three of us there, early days. Long story short, I never ended up going to law school, and like fast forward, nearly 17 years later, and I'm still in the kind of same space of investing in early stage companies and founders and entrepreneurs. From there, I went to join another early stage fund, which is today still called Silicon Badia, but back then had a different name. And then I went to manage 2454, which is a Abu Dhabi sovereign-backed government-related entity that was looking to kind of attract tech and media companies to set up in Abu Dhabi back then. And that attached to that, they had a $100 million early fund. It was both an equity fund, but it also could do other types of credit or IP based investing. So we did a lot of stuff like that. And then from there, by that point, like I was one of the few people in the region, I think, that had built some experience investing early stage, even though at that point it's quite early and there wasn't much, like the companies we invested in, few were able to scale up until like 2010, I would say. But then after 2010, you started seeing a difference. And then after that, Fadi Ghandour, who's founder of Aramex and also a prolific angel investor, he asked me to join Wamda to help set up Wamda at the time was a sort of a community ecosystem builder around events and evangelizing for the entrepreneurship in the region. And he wanted to kind of build out a fund on the back of that. So I joined to help set that fund up. We ended up raising one of the largest funds of their kind at that point in time, which was a $70 million, one of the first also GPLP kind of venture funds per se in the region. So we ended up setting that up. And I think at that point, we invest in a lot of like great companies like Careem Insider, Mom's World, Twiga, and a lot of companies that have really, we've exited actually from a good number of those, and that fund did really well. And then at some point, decided to spin out with some of the team to kind of set up kind of our own platform, which is how we got to Nuwa Capital, so which we set up about 3.5 years ago. We're a multi-stage type of investor, so we do everything from early stage, pre-seed. So we have a dedicated fund for pre-seed to Series A. And then we're also in the process of launching some new products that are different. So we're looking at private credit, where we advise a fund manager on private credit, but private credit for the innovation ecosystem, namely venture debt, but also kind of venture debt adjacent stuff, because we think there's a huge gap in credit for small businesses in the region. And then lastly, we see a really emerging gap at the growth stage. When we say growth, we really mean Series B, so tickets of 10 to 20 million. So starting to think about how we can build in that category as well. So, across my career, I think I've done about 300 tickets, 300, more, maybe 300 something investments, almost all in emerging markets, namely GCC, Turkey is the second largest geography, and then Egypt. And then have done a little bit of fund-of-funds investments in Southeast Asia, and a little bit in Sub-Saharan Africa, direct in Sub-Saharan Africa. But my kind of principal experience has been in GCC, Egypt, and Turkey. So yeah, that's the kind of genesis of that's my background and the genesis of Nuwa and how we got there.
Yeah, appreciate that, Khaled. So I think, I guess, over the course of that journey, going back to the Wamda days, as you remember, we built this content collaboration platform, then that got built out into a proper investing platform. I mean, what's your experience of talent evolution over that period? Because, you're talking about 2010, celebration of entrepreneurship, kickoff of Wamda, evolution into a fund investing platform, 2013, 2014. How do you see the evolution of talent in the region in terms of, give me a profile of how you see talent now versus talent then, and what the main shift in that has been?
Well, I think it's an absolute sea change, I think, in the nature of the talent entering the space generally. So the entrepreneurs, and not just the founder layer, but also kind of the management layer underneath the founders. Startups, early stage companies attract a totally different type of caliber and quality of talent today than they did back then. I would say that transformation happened. I like to think of the evolution of the region in terms of almost like cohorts and specific time periods. So I would say, 2007, 2010, there wasn't really much in the region outside of probably Maktoob.com was, the only kind of really game in town in the space, with some kind of smaller exceptions. I think between 2010, 2013, you started seeing kind of on the back of the success of Maktoob, the evolution of other companies like, Souq, which is an offshoot of Maktoob, which led to more and more opportunities come on the back of that. But then after 2013, I think you had this kind of explosion in internet connectivity, broadband internet connectivity over mobile. Somewhere between 2010, 2013, it really shot up. And that kind of made these businesses viable. And that's when you start to see the emergence of really interesting companies that had real scale and the attraction of a different caliber of talent to that between 2013 to, I think, 2017, 2018. And I think that's one period, that's I would say that's kind of the third period or third cohort. And that's, you know, the likes of Kareem came out of that. I think what's changed is with the Kareem exit, you really saw a validation of in 2018 of the fact that you can build a large scalable business and make money doing so. And so that validation really incentivized a lot of people who, you know, were thinking about starting a business, but had a more kind of traditional blue chip type of corporate job or investment banking job or consulting job to say, no, you know, that this can actually work. There is now a number of exits. And so post 2018, you saw like a huge change in that's almost like I would say, if there's a way to quantify the level of talent, I would say that's an exponential jump right after 2018 in terms of the quality and quantum of the types of people starting these types of businesses, early stage businesses.
So if I were to say, sorry to interrupt, Khaled. So if I would say one thing, I mean, I think you're completely correct. You know, the evolution of the founder experience, serial founders, we're increasingly encountering guys who've done it, or women who've done it 3 or 4 times. Just the track record of being a serial founder gives you an enormous amount of resilience, access to the right kind of talent. You know, the trial and error of having failed is a highly valuable characteristic.
Yeah.
The view that I've got, which is you see an exponential growth over that period in the quality of founders and founding teams, sparked also by an outflow of people from the consulting industry, because you get tons of really bright people. They don't want to be a McKinsey partner, no disrespect. You know, they don't want to have a career track, which is, you know, in EY or Deloitte. They want to be a founder. They want to take the risk, and they want to do 2 or 3 years of that and then do something of their own. And you see that characteristic in North America and playing out in our region. What's your view of the talent on the investing side? Because if I was being harsh, I'd say you've got an exponential growth in the quality of founders, and I don't know if there's an exponential growth in the quality of investors.
Well, I think investors have a much easier job, so it matters less, I guess. Like, it's easier for us generally. I think you have a lot of, I think also in that period, also similarly post Kareem and between 2019 to 2022, I think there was also this explosion of activity in the region, right? The sovereign wealth funds, whether in Saudi or the UAE, I think started to back, you know, made the policy change to back regional managers to catalyze a deeper venture and early stage investing ecosystem. And I think the way they did it was to kind of seed a lot of managers. And so you have big fragmentation of these managers and small amounts of capital. And so, because I think on one level, a lot of these sovereigns don't want to be seen to be choosing winners, right? Because they're ultimately like government-rated entities. So there's this kind of wide kind of number of managers that were basically created on the back of this kind of policy change. And, you know, the idea there was like, there are not that many people with a track record, so we need to kind of like see the few and then see who does it, you know, who's able to kind of survive, and then we'll back the second one, third one, fourth one if they perform. And I think that's natural. Obviously, are all the managers in the ecosystem today the ones that will be there in 5 years' time? No, I think there's a natural process of evolution and natural process of some form of winnowing, right? Like of the number of managers getting smaller, but with more with deeper pockets, basically, that will attract disproportionate amount of the LP capital, and that's kind of just a natural function of a growing ecosystem. So I think there are a lot of investors who are doing this for the first time, and they're learning, and there is some value to be doing it for the first time, for sure. coming with a fresh perspective. But I think there is some, to your point, Owais, that there's, there are some investors that perhaps won't get to the next stage because it's just not for them.
Absolutely. And just, what's interesting, Khaled, is when you look back at, 2010, 11, 12, again, I remember putting decks together in that period that talked about, the hotspots being the UAE, Jordan, Lebanon. That was the natural direction of scaling of opportunity with founders and, opportunities to invest in great companies. And then there was a phase where Egypt was everything. And actually, interestingly, I remember back to 2010, 12, no one talked about actually Saudi as the hotspot for founders. It was always Saudi, right, as an addressable market. And the entertainer had to be in Saudi, and Kareem had to be in Saudi, but no one was saying there's going to be this enormous explosion of entrepreneurial talent in Saudi. So to take us through that a little bit in your perspective, Aaron, how it shifted from a Levant focus into focus. Yeah.
Well, I think the long story was that to go through the kind of the history of the innovation ecosystem in the region. So if you go back to about 2007, 2005, mid 2000s, say, you really had a lot of the entrepreneurially driven companies emerge from, I'm not just saying even in the tech space, but kind of broadly. So you think of companies like Aramex, because I'm Jordanian, I'll give you Jordanian companies, but Lebanese, somebody Egyptian Lebanese could give you a lot of them as well. So whether it's Aramex or even older like Hikma, which is one of the biggest pharmaceuticals in emerging markets, these all kind of came out of the Levant because the non-oil economy, there was, the evolution of those economies were driven more entrepreneurially, at least in the early stages of these countries, the formation of these countries. I think with the importance of oil being a major driver of economic growth in the Gulf, that difference between the income per capita in the GCC versus the Levant started expanding, but so did economic, social, and policy instability in places like Egypt and the Levant. And I think that drove the wedge. But because those countries had invested heavily, the Levant and Egypt, in education earlier, you had a lot of nascent local talent that could emerge from there. So the conventional wisdom, fast forward to 2000, in the mid 2000s, 2010 is, the entrepreneurial activity is there. You have talent there, technical talent, engineering talent, etc., and they can kind of build businesses. And I think what changed was a number of things. The environment changed in the Levant, kind of both politically and economically in the late 2000s, really between the GFC. And then secondly, it became very apparent that the depth of market was in the Gulf, right? If you start a business in Jordan or Lebanon or Egypt, actually your addressable market is Saudi, UAE, and the rest of the Gulf. And it became very clear that Dubai emerged as a clear nexus or hub that talent wanted to live in. And it was a much, much easier place to address the Gulf than from Jordan. It's closer, it's faster, you have a local market there. So you had this sort of en masse and much better infrastructure, both soft and hard infrastructure. So just nicer place to live, plus soft infrastructure like regulatory infrastructure, ability to set up a company became much, much cheaper. Open, you'll be able to access global talent pool, not just a local talent pool. So all of that kind of position Dubai to be, you don't actually need to set up in Jordan. The Jordanian founder or the Lebanese founder or whoever the founder is from anywhere in the world kind of just comes, lands in Dubai and sets up there and can build a team there while keeping some kind of back office operation in places like Jordan or kind of engineering talent. So that's kind of how that shift happened in that 2012, 2014 period. So when we set up the Wamda fund, the thesis was just as you said, which is to look at companies in the Levant and kind of help them enter the GCC. But what happened by the second year of our deployment period is actually the companies that are still in Jordan, they're not the companies you want to back. Actually, the companies are already in the GCC And they may be founders from anywhere in the world. So we did that pivot, I think around by the end of our second year or so of deployment, that we got this realization actually that no, the companies are not in Jordan, and it's actually in the Gulf. The other thing is the other transformation I think worth mentioning, and this relates to talent as well, is investing in startups and venture capital initially, and this happens in a lot of markets, I think, is almost like a impact / developmental type of investing. But then where, there's some emphasis on returns, but there's more emphasis on kind of job creation or kind of supporting entrepreneurs or entrepreneurship, etc. But I think once you had reasonable exits, the shift happened towards, no, this is a viable financial asset class, and you could build great, profitable, large, scalable businesses. So you have that change, that switch over in that same period as the Gulf became the center of activity for entrepreneurship, particularly Dubai in that period. So those two changes happened kind of concurrently, and that, I think that's
Understand.
yeah.
Fantastic. And just from a perspective of, there are obviously a load of questions coming in, and I'll get to those in a second. But in terms of benchmarking the region, so again, if you take 5-7 years ago, Latin America pretty mature, evolving, some scale success stories, Submarino, loads of e-commerce type players. Asia, I think you also saw the emergence of an enormous e-commerce sector, Zalando, Tokopedia, Bukalapak, Lazada, all those kind of guys, a ton of emphasis. And, the solution around logistics in Indonesia unlocked an enormous growth in the e-commerce sector in Indonesia, and a ton of deployment, not just regional funds, but even Chinese money and so on. Where would you benchmark, Saudi plus GCC now compared, for example, to Indonesia, Singapore?
I would say we're about 5 years. I mean, it's not like it's Southeast Asia is the closest, I think, comparison to our market, because it's a collection of economies. If you aggregate, it becomes quite large. In the same way that if you aggregate, the GCC, Egypt, and even the Levant and potentially North Africa as the smaller markets, and then if you can add Turkey, then you have like a large piece of economic real estate. You have like a 3-point-something trillion economy, a large market. So that's where it's similar to Southeast Asia, is once you agglomerate like all of Indonesia, Thailand, the Philippines, Malaysia, with Singapore as the hub, then you have the kind of similar dynamic. There are some differences, obviously, but I think if you were to fit it such that you're going to make a comparison, I would say we're about 4 or 5 years out away from where Southeast Asia is today. And I think that's driven by Southeast Asia had their first kind of tech IPO roughly that kind of period ago, or a bit earlier. In terms of capital deployment, venture capital deployed or capital deployed in the asset class, I think we're kind of well behind where they are, but on the same kind of trajectory to where they would have been like 5 years ago. So I think in that sense, we are roughly in the 5-year range mark. Also, especially in terms of if you also benchmark against the number of companies, even though this is an arbitrary figure, but like valued over $1 billion, I think we are, where they were like about 6 years, 5-6 years ago. So I think by all of those benchmarks, we're somewhere in the 5 to 7 year range. But does that mean we're going to exactly follow their trajectory? I mean, we're building a business on that with that in mind, but it may kind of go much faster. It might go slow. It may be different, have a totally different different approach. I mean, the one kind of variable here is that the development levels and income per capita levels of Southeast Asian countries are, with the exception of maybe like Singapore, are kind of more even. They're more similar. Whereas here we have very wealthy GCC, high income per capita in the GCC, but much lower in places like Egypt, right? So there's a bit more lack of uniformity in what the addressable market looks like from a disposable income perspective. So I think it may not look exactly the same, but I generally at a high level, I would say anywhere between 5 to 7 years behind Southeast Asia.
Yeah, that's interesting. We'll get to that in a sec, Khaled, because when you take platforms like Kareem, And, you're building a business that operates in the UAE, it operates in Saudi, it operates in Egypt, it operates in Pakistan to a level it tried to operate in Turkey when we invested in it as well. You've got enormous unit economic challenges, because how do you build consistent consumer experience, consistent pricing, predictable take rates when you've got enormous differences? I mean, if you take Kareem, it's an upmarket product in the UAE because it's expensive. I mean, people will stand on street corners and in front of a hotel, which I've never understood. They'll stand in front of a hotel waiting for a taxi, staying at the, W Hotel or what have you. And it's like you could get a Kareem, but they're attuned to spending less. So what's interesting actually, Khaled, is here's a bit more of a technical question, and sorry if I jump about a bit. I mean, one of the things I saw post Abraj and in my current role at Rise Capital is the evolution of the sophistication of investment committee meetings. No disrespect, I remember it being, of course it was quantitative, and of course it was analytical, and of course you might have a McKinsey piece of DD, and you'd have a decent piece of investment screening, and you'd have a decent investor memorandum. But I tended to find hunch-based thinking featured fairly heavily in a platform, which is often the case with a founder-led platform. No disrespect to anybody, where you'll go, well, let's do that because I know that's going to play out this way. And whereas now, it even evolved when I left Abraj to the point where if you threw out a subjective hypothesis about something, you'd get shot down in the meeting because it's like, where's your data to back that assertion up? So tell us about a little bit of the sophistication of IC thinking and how that's evolved.
Yeah, so I think what's really changed is, the move from the intuitive, I mean, there's always a degree of intuitive thought in investment decision making. I mean, that's just the nature of it, right? Because you are basically synthesizing so many variables, even with a lot of data, that there is some level of intuition there. So that kind of remains. However, I think what's really changed is, like you said, that people really want to dig into the data because the data now is meaningful. So when you're looking at just to give an example, today at let's say vertical marketplace in, segment, and you look at the cost of acquisition versus the basket size, and you're looking at your PC2 through to PC4, meaning the profitability on a per unit basis, you have an understanding of what that means for these types of markets, MENA and other emerging markets. So there is now like a data set to benchmark against, whereas 10 years ago, I mean, it's anyone's bet. Like, is this good or is this bad? I mean, where is this going to trend and in what direction is it going to go? So whereas now it's not just leveraging like regional data from kind of multiple sources and people seeing different things, but also you have other emerging market data that you can plug into and see the difference there. So the process by which people kind of look at investing has become a lot more rigorous and, as you say, like much more data driven. We're kind of quantitative, I would say, rather than data driven for sure, but like quantitative, looking at the underlying kind of unit economics of a business in the segments that we look at, and then couple that with the more qualitative kind of stuff that we look at when we're kind of considering investment. As you go further along the development cycle, so at pre-seed, you're really betting on addressable market size, which also used to be not very quantitative, but now is much more quantitative, and the ability of a team to kind of execute on a vision. But as you go on, as the company is, goes into, if you're looking at company Series A or Series B, then there's a lot more to dig into on a quantitative basis. So it becomes much more rigorous from that perspective. So I think there's a stage question, and now we have companies of that stage. We didn't have companies of that stage like 10 years ago, at least within venture, right? Like we just had emerging companies.
Yeah. So it's interesting. I mean, I'm sure you'd agree. My experience has been that the more deals you look at in a given industry vertical, the more your benchmarking evolves. Part of the difference, I guess, 7-8 years ago, is you wanted to look at something in the entertainer space or in the e-commerce space. There are very few benchmarks, right? Direct to consumer e-commerce, minimal benchmarking, and then now you look at a deal, and just the volume of startups in that space means when you look at a deal, you've probably looked at 12 to 15 deals of that kind, roughly speaking.
Exactly.
8, 10.
In the segment.
So just absolutely. So just another question, Khaled, which is, in terms of in terms of founder characteristics and the maturity of founders, and these are a couple of the questions coming up, give us a picture how, and you can even name individuals, well, in the positive category, how's the sophistication, we'll leave the other guys behind, but in terms of the founder DNA, what do you look for in terms of the 2 or 3 things that you see are very repeatable characteristics?
So I think it's like, it's always very hard to articulate. So there's some things that are kind of harder, I would say harder attributes, and some other things that are a bit more kind of subjective. So the harder attributes, I would say, and we haven't done this benchmark in a while, but we probably should update it, which is like, let's look at the profile of successful founders and where do they come from, what do they look like. So they tend to be, just at a kind of very high generic level, and then we'll drill down to specifics. Mid-career, they come from mid-career professionals. They're not, university graduates or just like, in their, out of their first job. They tend to be, have had blue chip experience in their segment, typically. So either they worked at a multinational or a large corporate that's in the space. They're kind of intimately aware of working in the space and the challenges there. And so they've decided to kind of solve it in a different way. But they are, in the age range of, 28 to 40 or 40 something, that's kind of typically 28 at the earlier, 40 at the 40 something plus at the later. Up to 45, I would say, but they're not like 21 or straight out of college. Like, it's not that they tend to not look like that generally. I mean, there are always exceptions, but they tend to not look like that. Blue chip experience, very well connected. They tend to be people who are very, very well networked, either by virtue of their past experience or because they are from, especially in emerging markets, from the right kind of network where they've been exposed to a lot of investors and a lot of kind of suppliers, so they're in the mix. They tend to have had like, also blue chip university education, like, be very well educated. They tend to have been at, the likes of McKinsey, one of the big consulting firms, but not too long. The ones that have been at like McKinsey over a certain, and we need to update this because I think at one point we saw that the average is like 5 years. And then if someone spends over 5 or 6 years at like one of the big consulting firms, their kind of ability somehow is diminished because it becomes all theoretical concepts. I mean, that's a theory at least. But I think if you look at it, like the guys who've been there like 5, 6 years, they're good. But then those who've spent like almost all their careers there, then, as you were saying, the example, pre-partner want to step out at the 10th year or 12-year mark, then those tend to be not as good because I think they kind of get very conceptually interesting, present well, but then don't execute as well. Why that is, I mean, I don't know, maybe you get too ensconced in kind of theoretical frameworks as opposed to kind of making something happen, possibly. So that's at kind of the high end, at the kind of more generic and the more kind of quantitative way of looking at it. The more subjective one is you're looking for really a founder attitude where at the early stage, when there's not that much to look at, where you're looking at a founder who has clarity of vision and confidence in that vision, meaning they know what they want to do, and they can articulate the problem very clearly, why they think it's a big problem, and then why they think their solution is kind of revolutionary or paradigm shifting or is going to make a big difference. But at the same time, for early founders, you're also looking for that companies that the original idea is almost never what you end up with, because the company is going to pivot, evolve, change, develop its kind of vision, its product, its approach, its kind of DNA multiple times by the time it gets to Series A, let alone by the time it exits. So I think you want a founder that it balances that confidence of vision because they need to have a vision that they know where they're going towards, but also able to shift and change and evolve based on what the market and the kind of what the market is telling him or her, and what's happening to the business as it evolves. So it's kind of balancing those two things is a critical factor. And then number 2, being able to attract co-founders. So we always like co-founding teams over single founders, but also attracting interesting management teams. So you kind of assessing the founders by their ability to attract interesting people and inspiring interesting people with great backgrounds to work with them. I think those are kind of the more, I want to say, like fluffy attributes that are subjective. I mean, how do you gauge whether a founder is kind of thoughtful around, receptive to kind of how the market will react to their offering, and then amend it accordingly, and balancing that against a clarity of vision and not just kind of jumping from one thing to another just because, I heard something today and I heard something, the other day at the other extreme. So that's the key. That's the kind of secret sauce in a way.
Yeah.
Kareem founder is a great example of that. Bassam Arab from Tavi is a great example of that. Samih Tuqan, Hussam Khouri, early founders of Maktoub and Souq, they're excellent at that. Also, and this could be changing. One thing that always surprised me is a lot of successful founders in the region, not all, but a lot, are immensely humble. There's a lot of humility with them. They tend not to be very egotistical. And I find like a lot of the failed founders tend to be like, have like very big egos, but that's not always the case. And I don't know if that's, but I'm surprised by how numerous the kind of more humble founders are, because our image of the successful founder really is like,
I think
Steve
there's a fair
Jobs.
point there.
Yeah. Right. Like our image is like
Yeah.
Steve Jobs
No,
is
there's a fair
hard to
point
work
there.
with, like has clarity of vision, etc. And I think you can be that.
Yeah.
But I think that's not necessarily the template for our region, or I don't think it's the template unless you're kind of doing something that's really kind of generationally defining, and then your vision is kind of rebuilding the entire thing, which we don't see that many kind of founders that do that type of thing. You're looking at founders that are adapting global business models for local consumption, and I could theorize as to why, I don't know, but I think I'm always struck by like some great founders tend to be quite humble. We have in our portfolio like Iowa today, for example, they're on that path hopefully to that type of success. Incredibly humble guy. I mean, like these are lovely guys and very easy to know. There's no kind of big ego. There's no but they're confident in themselves, but without just very approachable, very easy to kind of deal with, etc. So I don't know if
I think
it's real or not.
yeah, no, that's an important point, because I think the humility plays out in multiple ways. Hiring talent, demanding talent who don't take coercive leadership readily. Okay, no one wants to be bossed around. No one wants to be, treated in a way which disregards their own career path. So I think that's a major piece of evolution. The other question is, Khaled, in terms of the spectrum, if you look at the cycle of value creation thinking, on the one hand, you've got the school of thought, which is a more private equity oriented school of thought of, deep functional capabilities in-house, expert network with 45 guys on it, a whole bench of former CEOs as your due diligence and post-value creation experts and board members. And then you've got, the very light approach, which you often find in VC funds still, which is minimal operational value add, a little bit of pull when founders demand it, but in general, a lot of the funds are not structured for really deep engagement around expertise. I guess it's an economic question, which is you can't pull in that kind of expertise unless you've got enough funds under management to justify those kind of people on the bench. But in that spectrum between, heavy operational, heavy lifting type capability and super light on sectoral functional expertise, where do you see the future for yourself, but also the future for regular funds in the region?
So we've kind of made the direction on this. So we think we believe that it's important to have that kind of heavy lifting on the operational side and value creation. So we have one of our partners, Nitin Reen, who comes from an operator background, who just focuses on that. And then we have, because we don't have the thing with VC, because the funds are relatively small relative to like private equity funds, you don't have the AUMs, you don't have the kind of fund size that generates enough revenue from management fees to hire a big team around that. So we do it, we try to kind of do it commensurate with our size. So we have kind of part-timers and people around that and on project specific and stuff like that. And so we believe in that. I really believe that that's kind of like an important part of our offering that honestly we would like to, as we build our platform and we hopefully, raise more capital and build our AUMs, to do more and more of that. And we're seeing that the founders really appreciate it. We make subject matter experts available to these founders, whether they're product guys or tech guys or recruitment, etc. The question is the kind of and this is kind of model really innovated by Andreessen Horowitz, which started with this offering. And the question is really, does this lead to kind of the creation of better companies, or does it just attract better companies to want to work with you because they want to avail themselves of the resources? So I think so. I'm not sure it matters, first of all, but I think in the US, and when I asked once, like Scott Cooper from Andreessen Horowitz, this very question, he said, probably we don't make companies better, but we make good companies want to work with us, or good founders want to work with us because they want our resources. And that's what got us like good deal flow early on. I think in our markets, actually, the later stage companies could really benefit from some of this kind of help once they get to certain scale, because very few have been to that scale before. So if you're able to aggregate some of that knowledge on an operational level to make them avoid, costly mistakes, or accelerate them a bit, I think that could move the needle. Whilst also, if they're getting value from it, then it, in these kind of founder networks, they'll start, recommending you to other entrepreneurs to want to work with you. That's our theory. Do I know if it's going to pan out? I don't. I mean, but we built the business on this basis, so we're hoping that it will pan out. So that's kind of what we think generally. So we've made a kind of like a stake on this. So we put a stake in the ground saying we think value creation matters a lot.
Yeah, and just a couple of quick ones. In terms of, and we'll shift to Pakistan in a second, but one of the things I've seen, I won't name names, but maybe I'll name one. A business like Kareem, where as you scale, you suddenly start getting corporate talent. So I literally remember walking in one day to Kareem, and it was very entrepreneurial people, Christian Eid and guys like that. And then a year and a half, you walk in and it's guys from Clifford Chance, and it's like, what happened? So no disrespect, but you suddenly start attracting talent from a different pool. You get more corporate individuals. You get less of the entrepreneurial flair, and you get more of the institutional flair. That can be good and bad. You go from basically shooting from the hip, gut feel, reasonably analytical, to basically corporatized, little bit skywards. So, Emirates skywards. So, how do you manage, in your experience, of an Iowa or a Kitopi, which we're invested in, and Kareem in your case, and, the scaled situations that you're now building? How do you encourage management, and how do you keep finding the really dynamic talent as opposed to just the corporate guys?
Well, I think like it's a function of both like the nature of the talent, but also, and sound like a broken record because I think people talk about this all the time, but it really matters, which is like engendering the right type of culture, because you're going to need that depth of talent that does have corporate experience, that does come from the corporate world, who have seen kind of like the breadth of whatever the field they're in, right? Like they've had like a depth of experience that's valuable. I think the point of culture in an organization is, besides, it's a nice place to work, etc. Because people always think that culture is like or make it a nice place to work. It's not necessarily the case, but usually that's a nice byproduct of that because people feel fulfilled. But it's about creating a culture where, you're able to unlock the value that the kind of corporate guy, the corporate profile has with their experience in an entrepreneurial environment. Because if you allow that kind of institutional culture to take root across it can kill an organization, and it happens all the time. Like you see it all the time, right? Companies die at that Series B level. So it's about, engendering a entrepreneurial culture, meaning making sure that first and foremost, and we can talk about this a lot because I was kind of thinking about it, but like first and foremost, having empowering people to kind of make mistakes and kind of make decisions and feel safe that in the decisions they make. Because when we say corporate, what do we mean really sometimes? Because a lot of times when we say like a corporate profile, it's somebody who's not willing to take a bet, really not willing to kind of make something happen because they don't want to be really accountable for it, right? Like, so it's kind of a cross-functional accountability, five people are accountable to it, so nobody knows who's accountable because their job's online. If they screw up, they miss this quarter's target. So part of culture building around that is how do you create an environment where you have the corporate person is empowered and has a sense of safety to kind of make decisions that can move the needle based on their experience in a safe way, where they feel they can be honest and open about it, and their progress in the organization is not so much about kind of their kind of politicking, but more about them being able to make things happen. So how do you incentivize a culture also, which is related to this, around people who make things happen positively are rewarded versus people who don't make mistakes? So that there's a balance there, right? It's not that you want to keep the people who don't make mistakes as much as you want to keep, retain, and incentivize the people who are making things move, and that's kind of a really important thing. And I think the second thing around that kind of culture is quick decision making, because like also when we say corporates, we mean like this kind of sclerotic decision making where it's like slow, it's very slow, right? Like partly because of that first point, which is everyone's like wants to kind of protect themselves, but also like it just has sign up for many people. So you need to find a way where decision making is quick, and that's kind of also nullifies that kind of corporate feel. I mean, that's just kind of some theories, but it's but that's what I've seen. Like Kareem, I think, was mostly quite good at that. I think, like Jenny, if I remember, really quite good at like streamlining that decision making, or do it, we're going to do it like that, especially for most of its life before the Uber acquisition. I think probably it worked. Yes, it did get maybe a bit institutionalized, right? Like, but I think that you can't get out of that. Like, that's just kind of the nature of it.
Absolutely. So just moving on, what we're going to do, Khaled, is just shift to a few questions and things which, and we'll come back to exits in a minute and scaling and pre-IPO. Yeah. Give us a picture, obviously, given the nature of Park Launch, give us a picture on your current perception and your evolution, your thinking on Pakistan.
So I think like there's also like this huge depth of talent in Pakistan, particularly on the technical and on the engineering side, that I think is super interesting. And I think, Kareem, I mean, we're using Kareem a lot as an example, but to stick with that, I mean, a lot of that, talent was built, a lot of that product and all that business was built out of Pakistan, right? So a lot of that kind of back office, the engineering was all built out of Pakistan. And I think that remains a huge untapped opportunity for businesses that want to target the region more broadly. So I think that's the play here. I think the concern with Pakistan investing in Pakistani-only companies or Pakistani-focused only companies is obviously the currency situation, right? Like that's the big concern, and that's not unique in emerging markets. Like this is kind of a common issue. So our thesis for Pakistan is sort of similar to Turkey in some way, even though they're very different markets. Is we're looking for companies that are either basing their kind of talent base in Pakistan, but serving the revenue is coming from outside of Pakistan, so either export driven or looking at kind of diversified revenue from elsewhere. You could have like large local businesses that are solving huge structural problems, but somehow you're able to denominate the revenue in dollars or in hard currency. So I think that's the challenge with Pakistan. But I think the immense opportunity is there's depth of talent at a very cost-effective rate, right? Like the cost is quite effective. So I think figuring out companies that are able to use this kind of arbitrage is the type of business we'd invest in. But would we invest in a purely Pakistan-only company whose revenue is all local, unless it's something that has huge infrastructure, is a huge kind of segment of, can grab a huge segment of the economy? I think it'd be tough, given what's happening on the currency side.
Yeah, fantastic. So what I'll do, Khaled, is bust through a few questions here from our viewers. What's your take of investment in Pakistan? I think we've covered that. In various interviews, you've expressed interest in direct to consumer. What do you like about direct to consumer?
Yeah, I think I need to come up with a new label for it because like direct to consumer has a bad stigma,
Yeah,
to it. I think there is this in the Gulf specifically, and MENA broadly, but Gulf specifically, the large consumer market. Historically, we are very focused here on importing global brands, right? Like that's kind of been the play. So we're, I think, over-indexed on importing and reselling local global brands here, and across spectrum, whether that's eyewear or fast fashion or luxury fashion or you name it. And I think there is a value to building, and two companies come to mind that kind of have shown that actually there's huge value in being able to build businesses that address local consumer requirements, starting on an omni-channel basis, meaning you're offline and online, and it's your own private label that is built with the local consumer in mind, both in terms of taste but also price point. So companies like Iowa, for example, fit that. Companies like the Giving Movement fit that. I mean, these are kind of like big successful examples of businesses built locally for local requirements, local needs, local price point, with the price point to quality trade-off ratio in mind. And I think that there's going to be a lot of opportunities to do that more and more and more in our region, cross segment. We're also invested in a company called Calo, which is a healthy meal subscription business, but they, it's end-to-end integration. So they own the food, they own the kitchen through to the customer, the last mile. And that I almost fit it into this category as well, because it's their own kind of local brand that is building for local, like a product for local consumer preferences. I think there's going to be so much more of this in the region. And I'm excited to look at it. And we're seeing more and more. And I think we're going to see, I'm still excited for it. But again, DTC is like people, it evokes memories of like, Dollar Shave Club or stuff like that. That's not what I really mean. Like, I mean, like, just building local brands. That's not very tech, I guess. Like they're just kind of leveraging technology in a native way from day one. They have a kind of an online channel married to their
yeah.
offline channel.
And give us a picture, Khaled, on valuation, right? Because, obviously post-COVID, you get really availability of cheap capital, and you get a high level of inflation in the valuation of companies, particularly in some core sectors. I saw tons of overvaluation in enterprise solutions in healthcare, tons of it in direct-to-consumer e-commerce, actually, etc. Give us a little bit of a picture as to how you look at valuation and how those have adjusted in the last couple of years.
So I think at the early stage, so I would also, demarcate by stage a little bit and geography. So Saudi companies that are born out of Saudi or founded in Saudi and have a kind of Saudi first flavor, I think there is more capital in that market chasing that. So you see valuations for companies that look like that not come down as much. I think for regional companies, I think cross spectrum, there's a huge kind of reduction in valuation for regional businesses across the board. Companies that have a regional focus. Because there's just less capital chasing that generally. At the early stage, it's much less dramatic, right? You're talking about changes between 50%, 30%, 60%. At the late stage, and when I say late stage, I mean like Series B, I think you're seeing quite dramatic changes to where they used to be before. So I think there's a lot less capital available for a large Series B today, like a $30-40 million Series B or Series C than there used to be. But there's a lot more money in pre-IPO. So interestingly, if you're pre-exit, so there is opportunities, like if you're done with fundraising and this is your last round. And in our region, we don't see Series F, G, H, like it just ends after Series C or D, and that's it. Because the market's not that big. This is not like a US company is going to conquer the world. These are really regional businesses. And so after Series D, you should be ostensibly done, basically, even Series C. So I think that last round, you have the likes of InvestCorp, Sanabil, even the likes of TPG, General Atlantic. All these guys are chasing those. They want to move a $50 to $100 million ticket. They want to do more in the region. It's a new frontier. they have a lot of LP base here, so they want to do it. But then a lot of the investors are at the early stage, so at the ticket sizes of $500,000, 100K to like 3-4 million. But then there's not many at the 10-20 million dollar range that are focused on that, up to 30s that can cut a 15 to 20 million dollar ticket. So I think that's a gap that we're quite interested in figuring out as well. So
yeah, a couple of quick ones, which is when you look at an investment thesis today, okay, and you look at AI as a theme, to what degree does AI play in your assessment of an opportunity, and how much work should founders do to embed that in their growth planning and value creation planning?
Yeah, we think of like AI as like a OpEx optimizing tool, right? Like that's kind of what the way we think about it. To give an analogy, if you were to kind of go back to the year 2000, for example, you're setting up a .com business. It used to cost you like $5-10 million just to get going. A large part of that is because you had to actually like buy server racks and like put them in your office and like build everything from scratch. You take that up to 2010, that same business, you'd only need like $1 million to go to kind of like raise it, roughly, give or take, let's say online e-commerce business. Because what changed was the advent of cloud services, which kind of really collapsed, had this massive deflationary effect on the price of infrastructure and starting a business. So on the capex side, right? So you suddenly don't need all that capex. You can kind of flip that into OpEx and kind of go from there, and then use it. Then you pay as you go, basically. AI has the same kind of deflationary effect and optimization effect, but on OpEx now. So I think that's what's super interesting. And for us is like how are founders looking to leverage today and in the future AI to kind of really make OpEx go far further, how to accelerate growth. You can, with the same resource, you can probably do like 3, 4, 5 times as much as you would have been able to without different AI tools. So we think of it as an accelerant and a cost optimizer in a way. And I think that's only going to increase very rapidly. So that's how we think about AI for our companies. We don't really look at AI applications per se. So we don't invest in an AI company unless it'll be very unique and we're going to have to understand it. But we don't, it's not our strength to kind of like do the actual like LLMs or something like that. We don't understand, frankly, it's not our, strength.
Yeah. And just a final question. If you had a choice, let's just say if you were limited in the region to 3 sectors you could invest in only, what would those 3 be?
Sectors.
Yeah.
It's a very good question. I think, I don't know if I would call them a sector. The way I think about it is like, there's this kind of huge, I'll give it to you kind of thematically and then kind of drill down into segments. So I think there's this huge explosion in certain parts of the economy, particularly in MENA, that are like, a step change. So let me give you an example. So we have this kind of growth in public markets here, really, like public market investing. So there's huge growth in liquidity, velocity, and just number of kind of transactions in the public markets. So it's interesting to invest in companies that are, help build that infrastructure for public markets, derivatives of that change. So, and that's kind of our theme, like derivatives of how the economy is being reshaped. Another great example, we all know kind of the Tabby story. There's this kind of huge growth in consumer credit in the region. So huge, like between Tabby and Tamara, but also other kind of, even traditional financial services. But that means that there's a huge opportunity in businesses that are built adjacent to that, meaning in the, whether that's collections or credit scoring, or, how do you package these products, securitize it? So there's kind of big opportunities around these, I would say, kind of derivations. So that's within fintech, generally, broadly. So I would say derivatives within what's happening in financial services that address the kind of changing of that market, I think is super interesting. private label, we said, I think there's something there. I think there's, whether that's it's its own segment or not, you know, I don't know. But like, I think if I was to define it as such, I think that I would definitely kind of invest in that space. And then SaaS for Turkey, I think huge opportunity in building SaaS businesses that go global from Turkey. We see them, we're deploying in them slowly but surely. And I think that's kind of like a big space. And then I know you said for three, I say the fourth is, I see it coming, change in how we think about healthcare towards much more deeply personalized healthcare that is, biohacking driven, personalized to your DNA and your circumstances. We don't see many companies in the space, frankly, but I think something is happening there, and I wonder, is there somewhere we can play in that space? And I think that's coming, and it's coming in the next 10 years, and it's going to be huge. And it's also because we have some of the largest per capita spends on healthcare in the world, in the GCC specifically, but even across the region more broadly.
Yeah. And in terms of, your global exposure to venture capital, give me the name of one person who's your most admired person in the industry that you've met, encountered, heard of, or just read about.
That's good. That's a good question. I think like there's a couple of people. So I haven't met him, but like, Mike Moritz from Sequoia, I think incredible what he's done with that, like really grew that platform. And he came in not as a founder, he came in as basically kind of like grow the platform. Obviously Mark Andreessen and they're really kind of incredible people. And Ben Horowitz, I think, to kind of really shaking up an industry, meaning they came out of nowhere to build like what is the largest venture capital firm. I think they're the largest by IM in the world today. They have a lot of, they're very kind of, they have a lot of critics, but there's that. And then at the far end of the other spectrum in terms of approach to investing, but like I've met and I've like was really kind of blown away by the meeting and by everything he does. Fred Wilson from Union Square Ventures. Yeah, I think incredible kind of discipline around the specific. Fund sizes are never big; they're always under, I think, 150 million. They've been doing it for years and years and years, and very focused, very deliberate, very disciplined, and has built an incredible franchise in a new. It was then a new market out of New York, so he built the New York ecosystem effectively. And I find it, deeply inspiring, and like, just also like his writings are awesome, and like I'm a big fan.
Fantastic. There's one question, which is, what's the best way to get hold of you? But I'll answer that. There's a certain person I know in a large regional sovereign. The best way to get hold of him is a shisha place in Barsha 1. The question is, what's the best way of getting hold of you?
Email is the best way, even though like my email is terrible. LinkedIn is, as you can imagine, we get lots of inbound, but I try to respond to it as much as I can. So my email is, I'll type it here. It's Khaled@nuwacapital.io. And
that's very kind.
Anything related to an investment, I try to do it. Sometimes, honestly, like I fail, but I'm trying to be better at being like very, very responsive. But yeah, email is the easiest thing usually.
That's really kind. That's really appreciated. So I think we'll end it there, Khaled. Really appreciate your time and your insights and your experience. And we'd love to have you back on. And, we can always follow up in a few months and just check out what you're up to with regards to the platform and the expansion of the platform. Would like to thank everybody who's sent in questions, who's listened and who's participated. Etc. Oh wow! Somebody's realized who I'm talking about on the Barsha Shisha thing. So basically, look forward to staying in touch, Khaled, and best wishes, obviously, from all of us to Nuwa and to yourself and to what you're trying to achieve.
Awesome! Thank you so much. Really appreciate it.
Thanks a lot. Awesome. Great. Thank you. Thanks a lot. Thank you.